if somebody's not here, for instance. Okay, anyway, so notice too that the income tax, I mentioned this last time, the income tax is on one line, right? Before income from continuing operations. It's on one line. All right, guys? That one line is what? The tax expense for everything above that line, all the revenues less the expenses. Then notice everything that's in red there down below, or the discontinued operations of these part, extraordinary items should be the same way. Everything's shown net of tax. Got to remember to do that. Okay? If it's a gain, it would be tax expense. If it's a loss, it's tax benefit. Because what happens is you're offsetting your gains. I'm sorry, you're increasing your income by gains, right? So you have more tax expense. You're reducing your taxable income by the losses. So you might show positive tax expense, right, up under operations, income continuing operations. Then when you get down to the bottom, you might have a tax benefit going the other direction. That makes sense? If you got $100,000 of taxable income, you're in a 40% tax bracket on your tax return, you got $40,000 of taxes. But then if you get a loss, right, down below the line, what can you do? Right. You can offset on your tax return. That makes sense? So if I had a $20,000 loss from an extraordinary item or a discontinued operation, so I had a $20,000 loss in a 40% tax bracket, that would save me $8,000 of the taxes. Make sense? So you show your regular taxes under the regular income tax expense, what it would be on that income, and then you just show the effect on the discontinued operation of the extraordinary item down below. That making sense, guys? Okay, so you can see they're both less applicable income tax, and I think you should say expense or benefit. Obviously, if it's income, which in the first one, the income from operations in the pizza division, less applicable income tax at 24.8, what is that? That would be tax expense, right? And what must have been their income? We did this last time. What must have been their income from operations up to the point when they decided to dispose of the pizza division? Yeah, it's 54 plus the 24.8 tax that they reduced it by. Absolutely. Now, it's a loss, though, on the actual sale, right? On the actual disposal of 90, but there's 41 income tax what gain? That's a benefit. Right? You might write it in your book right there. Income tax benefit. One's an expense, one's a benefit. I wish they'd done the other half. Okay? So the benefit, so really how much loss did I have? 131,000, but I saved 41,000 of taxes. Do you see what's going on? And how could you save the 41? Well, you have 184,000 income tax expense above, right? You just reduced your tax by that amount on your tax return. What would be on the tax return, by the way? 184 of tax expense, see it? Plus 24.8 minus 41. Boom. That's what's on their tax return. Everybody good? Not too bad, huh? Everything's net of tax. And extraordinary items are going to look exactly the same when we get there. And I mentioned last time on discontinued operations, you show both the income from operating it from the beginning of the year to the point where you decided to get rid of it, right? That's what's in that income from operations for the disposed of division, right? That's what's in there. That includes, okay, so that includes everything that happened up to the measurement date. Now, what's going to be in the loss on disposal? Actually disposing of all the assets and closing down all the liabilities and everything. But what else? Operating it from the measurement point forward, which is typically a loss. Because what happens when you decide to get rid of a division? What do you start doing? As soon as you make that decision, closing it down, laying off people, selling inventory at liquidation value, all that sort of thing. So typically that would make your loss of disposal bigger, or make your gain on disposal smaller, right? Because you're wrapping the thing up. Severance pay and all that stuff. Everybody got the idea? Retraining employees. Okay, so this making sense? That's a real important distinction. So when you look at income from operations, that's through the point when you decided to get rid of it. And then when you look at loss on disposal, that includes closing it down and the gain or loss on disposal. Okay, so good. All net of tax, of course. And they run through some examples. Lovely. Okay, we show both. We did this last time too, didn't we? And there they are. That's what we were just talking about. Okay? That's where we were last time. All right, intra-period tax allocation versus inter. What does intra mean? Inside. What does inter mean? Inter-period. Between years. Allocation between years. Okay? So intra is inside, right, inside. So all they're saying is, look, you separate it into what? Income from continuing operations, discontinued operations, and extraordinary items. We beaten that to death, the author and I? Okay, so the key thing is, oh, by the way, what do I mean by the line? Which line is the line? The author kind of talks about that too. Without a discontinued operations, this would be net income. That is the line. Income after tax, got it? But again, if you don't have any discontinued operations or extraordinary items, you just call that net income. Yeah, got it. It's just net income. Okay, good.
And so when you go back to that, so for the earnings per share, he would start from the
Okay, earnings per share, great question. Where do you start? Income from continuing operations, that 276, and everything thereafter. Okay? Everybody got it? Every line thereafter. In fact, if you look at page 172, they did it there, didn't they? See the per share? Starts with the income from continuing operations and does every line after that. If there's extraordinary items down there, you do them too. Okay? By the way, how do you know what order to put discontinued operations and extraordinary items in if you have both? Discontinued first. Do them in alphabetical order over there. Or you could, I used to use DEC because it changes in accounting principle. Used to go there too. Now they're in retained earnings. DEC. Now you can use DEC. Think of DEC. DEC. Anyway, DE. Or Digital Equipment Corporation. Before I knew DEC, I used that one. Yeah. So anyways, keep it in alphabetical order. D first, D. I don't know. That's how we do it. That was DEC. All right. And here's another example. This is pretty good disclosure, though. Don't you like this better? Here's the gain. And here's the applicable tax. What should this be? Expense. Call it applicable tax expense. But it's kind of nice to have two lines. Or you can do it parenthetically, like they did in the book, right? I said that, didn't I? On the face of the statement, parenthetically, or in the notes, or in a supporting schedule. I'd never use a supporting schedule for something this short, would you? Whole piece of paper to do that. But you might put it in a note, or you might put it parenthetically in parentheses, right? I guess you didn't put parentheses around it, but it's same thing. On page 172 there, that's what they did. Make sense? Option. Okay. All right with this? Boring? Good. As long as you're bored, that means you know what's going on. Okay, and then here they've got income, right? Or a loss, rather. Here's a loss, and they did call it applicable income tax reduction. That's fine, or benefit. Okay? So this loss is a debit. That's a credit, right? Reducing your taxes. Net debit. Okay, good. Be able to handle that. To be extraordinary, it has to be material, unusual in nature, and infrequent. Right, guys? We knew that. And it's shown net of tax. Okay? So extraordinary items, how are they going to fall out? Take a look over on page 174. There we go. Oh, by the way, this is a cool one. International perspective, you're reading about that stuff in there too. Right? Anything that's in the margin, anything that's highlighted, good idea. Take a look at it. Special reporting for extraordinary items is prohibited under IFRS. They think we're crazy people to have extraordinary items. Just put them in as non-operating, basically. Okay? Can't agree with that. How many extraordinary items do you think there should be? There weren't very many on that chart that we showed. We looked at, were there? Hardly any. Is that a good thing? Yeah, it is. They're supposed to be unusual and infrequent, so very rarely. Horrible memories. The Trade Center bombing. 9/11, was that an extraordinary item? No. It happened to too many companies. Let's hope it's infrequent. But it wasn't unusual because it happened to a whole bunch of companies because there were so many companies that had offices there, headquarters there, bought things from those people, sold things to those people, did transactions through them. It affected a huge chunk of our economy when that building went down. It was not an extraordinary item, they decided, because so many companies would have had an extraordinary item because of it. How is that extraordinary? So this is really, really something, guys. Okay? I might have in principles told you this. If you have a building down along the Ohio River, those restaurants along the Ohio River, are you aware that some of them are on the river side of the flood wall? Below the flood wall? Kingfish, right, is. And then some of them, the crab shack is raised above the flood wall, right? It's on stilts above the flood wall. They're a little more protected, although it could knock that out too, although it's pretty secure, right? But some of them, when it floods, they just have water. If the water actually went to the top of the flood wall, they would get their first floor destroyed. Okay? At Kingfish, their basement, it's all picnic tables and concrete. You ever notice that? Why? The water comes up there every year, right? And they have to clean it out. That's the cost of doing business. They're not going to get an extraordinary item because there's a flood. They build on the riverside of the flood wall. How about if you're on the other side of the flood wall? What's over there? Hooters. Yeah, there's a place storage, right? On the other side of the flood wall, right? How about if the water goes over the flood wall and floods there? It's a 100-year flood wall, you guys. I think you got an extraordinary item. But that's how tight it is, right? Okay? So if you build someplace where you're at risk, so what? How about if a government expropriates your property, takes your property? If you are in Afghanistan and that happens, is it an extraordinary item? No. How about if you're in Canada? Yes. Why? Stability of the government, right? Make sense? Okay, so it's not what it is, it's how infrequent it is, how unusual it is, okay? All right. So are these items extraordinary? What do you think of this? And a lot of times I don't agree. I don't think extraordinary items should be things that are man-made. If we caused it, like a strike, if you're management, you did not cause a strike necessarily. But if you have one, hey, that's just business. It's not unusual for there to be strikes. Hopefully it's infrequent for you, right? What if you sell one of your assets? You sold one of your assets. How's that extraordinary? But anyway, I've seen them go both ways on CPA exam questions. A large portion, by the way, how do you know what to do on the CPA exam? Get the answer right, that's it. We'll be working CPA exam questions. You're going to say, well, I disagree with that answer. And I say, yeah, I kind of agree with you. That's probably wrong. And they say, oh, well, you give me credit? I can say, of course not, because on the CPA exam, they said that was right. And you're not a CPA yet. Once you're a CPA, you can disagree with them. In the meantime, figure out what they want you to say. You like that? You only need 75% to pass your test. There are going to be a few you disagree on, and therefore you miss them because you interpreted it differently. Yeah, you'll be fine. Okay, I'll be all right. So anyway, maybe that's one of the reasons why. Nah, it's just real hard. A large portion of the tobacco manufactured crops are destroyed by hailstorms. Severe damage from hail storms to the locality where the manufactured grows tobacco is rare. Is that one extraordinary? It's rare. The citrus grower's Florida crop is damaged by frost. No, why not? They have frost every year. Some get nailed, some don't. And it's really weird too because you could be right next to your property, right next to somebody else, and you're wiped out, and they're just fine shaded. Same storm. I mean, it happens all the time, doesn't it? Okay. By the way, the one who didn't is going to have a really good price for their crop. The other one is going to have a disaster. Right? Crop insurance. Okay. Anyway, actually, the one that didn't get damaged benefits a lot more than if nobody had it. Right? Price going to go up. A company sells a block of common stock of a publicly traded company. The block of shares which represents less than 10% of the publicly held company is the only security investment the company has ever owned. Only one ever.
Yeah.
Extraordinary? Do you think it's really extraordinary, or did they make it themselves? Let's see. They say yes on this one. I kind of agree with them. They threw in here is rare. That helps you, right? They could have even said very rare. That would have been even better. Okay, no on that one, I agree. They say yes on this one. I totally disagree. That's absurd. You bought the stock, it went down in value, you sold it. That's an extraordinary item. Is it unusual for stock to go down in value? It doesn't even get unusual. It does get infrequent. It's the only holding you ever had. And you will see ones like this, and they want you to say yes. So I don't know how. Although sometimes they'll see one like this, and they say no on the CPA exam. Isn't that something? Judgment, guys, judgment. Okay, a large diversified company sells a block of shares from its portfolio of securities, which is acquired for investment. This is the first sale from a portfolio. Why not?
Just because it's their first sale, it doesn't mean that all the other ones haven't gone down.
Oh, they're going to do a whole bunch of other sales, right? Because it's not the only stock they've ever owned. So that's the difference? Nah, neither one of them is. But anyway, this one is less, I guess so, huh? An earthquake destroys one of the oil refineries owned by a large multinational company. Earthquakes are rare. Anything? Yeah, because they said rare. A company experiences a material loss in the repurchase of a large bond issue that has been outstanding for 3 years. They regularly repurchase bonds of this nature. No, but you know why they threw that one in? Because it used to be. refinancing debt. But it's not anymore, so that's why they threw that one. So anyway, all right. You know what? Extraordinary gains and losses are going to look exactly like discontinued operations, but there's a big difference. Discontinued operations go on two lines, right? One from operating it through the measurement point, and one from the gain or loss of disposal. Extraordinary items are just going to be the gain or loss of the extraordinary item. Got it? Okay. And so this one has a what? Extraordinary gain, condemnation settlement. Okay. So somebody condemned your property, right? And you weren't expecting it. It wasn't predictable, right? So what's the deal? Less applicable income tax. Tell me what other word they should have there. Expense this time. It's a gain. Should have been expense. Easy, huh? And in these problems, we'll always tell you the tax rate is 30 or 35 or 40%. In real life, you have to figure out how much tax applies to each one of the gains and losses and the income from continuing operations. So it won't necessarily be the same tax rate everywhere. Okay, but anyway, a couple of ways of doing that, averaging it with and without the gain or the loss, and we'll do that in a later chapter. Okay, so much later chapter, not this class. All right, this one's a loss, and you can see what happens. What would we call this? Applicable income tax benefit. Yeah, it's a loss, so we get a benefit. So our tax bill went down by 30. It's no big deal, is it? Okay. And here's what it looks like when you put it all together. Illustration 419, is it?
Keith,
Yes.
could you go back real quick? Just wondering. For that one, the 70,000, would you want to put that in parentheses, or would you just?
Oh, you don't have to. They labeled it as a gain, right?
Or a loss,
And you can, or as a loss rather. They label it as a loss, and you can see 175 less 70 is 105.
Okay.
Some people would, some wouldn't.
Okay.
It's real flexible, right? Things that are down below the line, a lot of times people put brackets around the losses, not around the gains. Some people, if you have a loss on the income statement, net loss, or loss from continuing operations, sometimes you put brackets around, some don't. It says it's a loss, it's fine. Right? People should be able to read. I like brackets around here. Okay, anyway, this is on page 178, huh? And, you know, you're not going to see very many that are this complex, but be able to put together something like this. Again, what is operating, guys? What is the normal operations? See this income from operations? Yeah. Sales less cost of goods sold is gross profit, less all the operating expenses. They could only have selling and administrative, but you could have more if you wanted, right? A lot of times you will see that less than half of the income statement is operations, because that's all you have to disclose for operations. And then all this other stuff's required disclosure that comes at the bottom, right? I think it's a little screwed up, but that's how we do it. Okay? So here's income tax expense. You could have the word expense on there, or you could call it provision for income tax. That's income tax expense too. You see that? Okay? How did that get there? Journal entry. How did that income tax expense get there? Debit? Income tax expense. Credit? Income tax payable, current income tax payable, and credit deferred income tax payable maybe. Or maybe you have a debit to deferred income tax payable if it went down. That could happen too. Or it could be a credit to cash if you're paying the tax with cash. But usually you'll pay the tax later, won't you? You'll debit income tax expense, credit tax payable, later when you pay it. Debit tax payable and credit cash. Like any liability, huh guys? By the way, is that an accrual or a deferral? I just described. It's an accrual, isn't it? Debit tax expense and credit tax payable? Sounds like accrual to me. Yeah, okay, so sure. We accrue income taxes payable. Accrue all kinds of expenses. By the way, is this an expense? What's an expense for a business? A cost they incurred in an attempt to generate their revenues, earn their revenues. Is income tax expense a cost you incurred to generate revenues? Yeah. Tell you what, try not paying them and see what happens. You won't have any revenues anymore. The government will take all your assets and sell them. So is it a cost of doing business? Yes. Does it generate revenues for you? No, I don't know. You wouldn't be in business otherwise. So that was a little bit of a stretch, perhaps. So are there any questions on any of this stuff? You know, so far?
Why is the loss on disposal part of textile division up there in operating?
Oh, that's a good one. That's a good one. Yeah, great question. Loss and disposal of part of textile division. Why is that up there? What things, so this was operations. I didn't finish my thought. What is this stuff down here? The other expenses and losses. What's another name for that? This is operating up here. What's this stuff down in here? Non-operating. Before the discontinued operations and extraordinary items. That section right in here is non-operating. Whoops. right? This stuff in here, right? That's non-operating. So they are what, by definition? They're not both unusual and infrequent. They are either unusual or infrequent. And in the case of the discontinued operation, this is a disposal of part of a division. This is a disposal of all of a division. What are they implying to you? The one that's all of the division is a discontinued operation. It's a significant chunk of the business, right? Okay, material. How about part of a segment? What are they implying by putting it in the non-operating section there? It's not a discontinued operation. It's not material. It's not big enough. That's an excellent question. Thank you for that. Okay? And notice that's just up with all the other income. So when you're looking at a problem idea, if you were on the CPA exam or in real life, what's the decision you're going to make? How big is it? Remember I said if Nordstrom's gets rid of men's clothing, that's probably a discontinued segment, so material to them. What if Nordstrom's gets rid of green ties? We just don't want to sell green ones anymore, but we're going to keep everything else we've got. That's probably going to go up above it, non-operating. Maybe nowhere if it's really immaterial. Well, that's probably fairly immaterial. Are there a lot of green ties in the world? Yeah. So why would you do that? I don't know. I gave the example of Lay's potato chips. If they got rid of one type of potato chip, it'd probably go up there under non-operating, maybe, right? If they dispose it at all, right? What if they get rid of potato chips? They still have a lot of products left. They get rid of potato chips, right? What do you think? That's a discontinued thing. Okay, we good? And when Pepsi got rid of Pizza Hut, what do you think it was? Yeah, I think that's a discontinued operation. What do you think? Okay. Oh, we didn't talk yet about the minority interest. All right. What's the deal with that one? We come down to net income, and then we have this subtract the income that applies to minority interest or add back the loss if they have loss, right? Net loss. What's that?
Subsidiary.
Well, yeah, but it's a portion of your subsidiary's income that is what? That belongs to the minority shareholders. That's all it is. So you figure out how much of your net income for the consolidated company, right, belongs to the minority shareholders. Remember that little bit of consolidation we did in principles, a very little bit, that elimination entry we did, right? And we recorded goodwill, and we recorded the minority interest, and we got rid of all the equity of the subsidiary. Remember that stuff?
Yeah.
Well, the other thing you do is you figure out how much of the income belongs to the minority shareholders, and you subtract it so you can see how much belongs to the company's shareholders. That's all it is. This is not a big deal. So if they give you a dollar amount that belongs to the minority, could you subtract it out? Yeah. It's all good. Somebody had their hand up there. Yeah, I answered.
Oh, yeah. I was just saying it would be from the net income, not from my.
Well, actually, they own some of the revenues. They own some of the expenses, right? They own part of this, whatever percent of the company they own. So it's their revenues less their expenses. We don't separate all that up. We just come up with what is the minority share of the income. And it would only be the share of income of subsidiaries, right? There are no such thing as minority shareholders in the company itself, right? All their shareholders are real shareholders, right? Okay? And then the company owns stock in the subsidiaries. And so that's owned by the company shareholders. It's just the outsiders. That's the minority interest, right? The outsiders own part of the subsidiaries. You guys all know what a subsidiary is, right? Company that we own at least 50% of, yeah. So what would be the minority interest? If I own 60%, somebody else owns 40. And then you do it for all your subsidiaries. There might be a bunch of companies, right? Okay, good. All right. Irregular transactions such as discontinued operations during time should be reported separately where?
Both.
You think so? I do too. Well, you know, these kind of questions are just not a big deal. Sure, they got to be disclosed. No matter what. Okay. I told you guys to read these, right? What page is that? 179. Yeah, there it is. This is really interesting. I have underlined where it reads a little bit. It's weird. In the book where it says A, net income, B, pre-tax income, and so on, and there's a chart, that's not the same one. meant to talk about the one on 179. Sorry. Take a look at the one on page 179. What metrics do analysts create from the income statement? So if you think about the income statement, this is what do people use? Not so much as create. What do they use? How many are using net income from the income statement to do their analysis? 10%. Look at that. What's EBITDA? EBITDA, the second one. That's going down. We must have that somewhere here. Oh, they didn't do it.
Income before interest, tax, depreciation.
Yes. Okay. Notice down there it tells you what they are, where it says A, B, C, D in your book on page 179. A is net income. B is pre-tax income. Okay, that's one. C is income before interest and taxes. That's EBIT. And then income before interest, taxes, depreciation, amortization. And look how many people are using that. 27%. And then the next one is operating income. How many people are using that? 31. So those are the big guns, huh? And then we have comprehensive income nobody uses, right? 10%. Is that 10%? No, 7%. Okay. Pre-tax income, nobody's using that either. Okay. One of them, comprehensive is 6, I guess. Pre-tax income is 7. But the big guns, about 60%, are EBITDA, right, and operating income. What do you think about that? Think about the income statement we just looked at. Take a look back over on page 178, right next to it. Which numbers are they using? Tell me which line there is each one of those. Which line is operating income? Operating income. Well, I don't know. That's income from continuing operations, which would be net income if it didn't have extraordinary items, right? 500,000. Oh, it's 500,000. It's even before tax. What do you think? It'd be the 500,000. What do you think? You like that number? To analyze all the companies compared to each other? With all the different tax rates, different tax planning? Whoa, I think that's scary. That's what analysts are doing, apparently. I think I'd use a whole bunch of different numbers, personally. Right? I care about what's going to continue into the future. I think taxes are going to continue into the future. I don't know about you. Now, all those, if you look at our statement on page 178, all those discontinued operations, extraordinary items, we hope they're not there every year. But I'm going to think about, well, how often are they there? What's going on with this company? Okay, should I consider those things or not? And then, what would EBITDA be? We can't even get back to that here, can we? It'd be the 500 plus what? Interest, taxes. They don't show interest separately. We'd have to go find it. And then they'd add back their taxes, right? Which we can do that, right? And then their depreciation, amortization, we'd have to go find that too, which we could do. I think that's even a worse number. Operating income is probably better than EBITDA. And you'll have people say, oh, I use EBITDA to analyze. Now you know what it is, huh? And you can say, whoa, let's pull out a real statement. Let's look at it, and let's see what's going on with these guys. They might be losing a fortune, and the losses are all where? Discontinued operations, extraordinary items, maybe, but more likely, where are they? Non-operating. They might have huge losses in non-operating. Might get to it. And the interest bill might be extremely high, interest expense, and the depreciation is huge. So it's not that there's anything wrong with taking different metrics. That's fine. Use a variety of them. Okay? So that's kind of interesting to see which ones are the most popular there. I look at that and I think, wow, are you guys kidding me? Okay, non-controlling interest we talked about. Beat that to death. And then, yeah, the income attributable to non-controlling interest. Fine. Okay, and we looked at that. Okay, so good. All right, so this summary thing is really very, very good, huh? What page is that one on? 177, okay? Know this inside and out. I'm not going to have you write an essay, but I'm going to have you do statements, right? Can you do it? If it's unusual or infrequent, where does it go? Non-operating. What kind of things? Gains and losses on selling stuff, buying stuff, right? Sometimes, we'll get to that later. Maybe refinancing debt, okay? So it's not shown net of tax. Why not? Because it's before the line, right? It's before tax expense. Okay. What if it's a disposal of a segment of a business, but it's not considered material enough? And that would be under non-operating too, okay? And then, but if it's disposal of a segment that's material, clearly distinguishable, like they say here, what do we got? Separate section, discontinued operations. Show two lines, both net of tax, right? One from operations, beginning of the period through the date you made the decision, and the other one, the disposal, beat net to death. Okay, extraordinary items have to be what? Both unusual and infrequent, huh? Sure. Okay. Know this stuff. Anytime there's a blue box, I have written on my book KNOW with an exclamation point, an arrow pointing right at that. Okay, know it, yes.
So for discontinued operations, if you were to like say on December 31st, we're not going to continue operations, would the loss carry on to the next statement?
Well, no, if you haven't made the decision to get rid of the segment by December 31st, and that's your year end, right? If you haven't made the decision by your year end, you don't do anything.
No, like if you said,
right? I mean, it's just part of your operations, right now. But if you make the decision to sell, maybe that's what you make the decision. Let's say you make November 30th, you make the decision you're going to dispose of it, and you don't dispose of it until February of the next year. Say your year ends December 31st. What you would do is you would have to estimate if you're going to have a gain or a loss on sale, right? So then what you do is you show your operations from November 30th to December 31st, right? As you separate it, and you show gain or loss on the operations, right? At that point, okay? And then what you do is you estimate the gain or loss of disposal, including any operations beyond that point. Make sense? Okay? And if it's a loss, you go ahead and disclose it now, net of tax effect, right? If it's a gain, you just footnote it and you wait to report the gain until the next year. So it's based on your estimate. Why would we do that? We're conservative. Losses need to be disclosed as soon as we realize we're going to have one, even if it's estimated. Gains, we're conservative. We're going to wait until we really have the gain before we book it. Nice question. I mentioned that last night too, but a little bit hairy. So we give you something like that. You got to separate the 2 years, huh? But remember, as soon as you make the decision, everything after that is part of what? The gain or loss of disposal. What if I have a loss on disposal, but I have a gain from operating? It'd be kind of weird, but what if I did? I'd offset those two, right? Operating it from the measurement date forward, right? I'd offset those two. What if I have a gain on the disposal, but I have a loss from operating it from that date I made the decision through the financial statement date? I'd offset those two. They're both gains added together. They're both losses added together. Okay? So the real distinction is, when did I make the decision, right? Before it goes in that first line in discontinued operations, right? From operations. And then after as part of the gain and loss of disposal. One line. Okay? Did that answer? Good. Good. All of it next to net of tax, huh? So one could be a gain, one could be a loss. Right? Okay, cool. All right, new stuff. All right, how to do earnings per share. It's going to be net income less preferred dividends divided by the weighted average of common shares, because people are buying and selling shares all the time, right? Typically the company is issuing shares. That we're not talking about shares being traded out in stock market. Those are still outstanding, right? We're talking about outstanding shares. How many shares are outstanding? Because the company might be issuing stock as the year goes on, and they might also be buying back treasury stock, right, guys? So what you do is you figure out how many shares you have every day outstanding, add all the days together, and divide it by 365. Weighted average number of shares. Got it? Okay? And obviously, for a small company, the shares might not change all year, or maybe they just change once a year when they issue some stock. So it's a pretty easy calculation, huh? Okay, not a big deal. All right, anyway, why do you subtract the preferred dividends? Because that earnings doesn't go to the common shareholders. It goes to preferred shareholders, right? You're paying that dividend to them. So that, and by the way, is preferred dividends an expense? No, dividends aren't an expense. Preferred dividends don't come out of net income. So the net income, part of it belongs to the preferred shareholders, the preferred dividend, and the rest belongs to the common shareholders. You guys staying with me? Right? Am I getting pretty good at making your head hurt by the time we're done? I hope so. As we go through the chapters, I'll get better at it. Then stuff will get worse. So, yeah. Gotta have a headache every day when you leave class, so it's not a good accounting class. Okay, anyway. They say this is a significant business indicator. You know what? It's a shortcut. It's nice. You can look what earnings per share is, and you can take it times your number of shares, and boom, you got it, right? Because, you know, I don't know about you guys, but I don't own 50% of any company, so, you know, I am an infinitesimal percent of big companies. So anyway, measures the dollars earned by each share of common stock. It's good. Must be disclosed. Okay, so they do an illustration. I don't know why they do an illustration, but if you can't do that, don't worry about it. Okay, this is what it looks like, though, on earnings per share. So they show that on page 178 too, at the bottom. That's what this is. This is illustration 419, page 178. Notice where you start. It's with what? The line. And everything thereafter. The safest thing is to do every single line. I suppose you could do this 36,000 line and not do these two. They did every single one of them, didn't they? That's the safest thing. It's just the weighted average number of shares into every single one. Look at how much of this income statement ends up being extraordinary items and discontinued operations and earnings per share. Can you tell I'm not a huge fan of earnings per share disclosures? I think this stuff up here is a lot more important than this down here. But people like it, so it's fine. By the way, if you just show me the 276, am I going to be happy? No, no, no. You must do every line below. Got it? Every line. Pretty good. Yes, disclosure. And people apparently like that disclosure. You do. Okay? Fine. You know what's kind of silly about it is year-to-year earnings per share. What if they do a 10-to-1 stock split? What happens to earnings per share? It's not comparable. So you have to go back and restate all the years you're comparing to, right? As though they had already done the stock split years ago, right? You got to do that. Well, with incomes, you don't have to do that, of course. Okay? Of course, you do have to adjust for time value changes, right? Inflation over the years. I did tell you guys that when I started working, this year, I made $800 a month working for Arthur Anderson. Here I got out of school. $800, that was pretty cheap, wasn't it? What's that, minimum wage now? No. Less than minimum wage, right? 7.25 is that minimum wage. You get 2,000 hours a year. It's probably worth 2,500 a year, right? For 9,600 a year. How much are you guys going to get now when you graduate? Low 50s. It has the same purchasing power. Has there been inflation in all those years? 40 years, whatever it is. 43 years. I don't know. Okay, 43 years. Okay, has there been a lot of inflation? Yeah. In recent years, not very much. In some earlier years, it was pretty bad. Okay, but sure. Okay, so now who would compare 40 year ago company to now? But what if it's 5 years ago and there's been a fair amount of inflation? You need to compare. So what if you're doing business in Latin America, say? When inflation goes crazy, go on. You know, you really need to adjust for price level changes. And we talk about that every once in a while in this country. Back in the 1970s, believe it or not, that's the last time I think, they were talking about having price level adjusted statements because we had so much inflation. If you have inflation of 10% every year, right, you need to adjust your statements for inflation. What if it's only 0.5% or up to 2% a year like we have now? You know, nothing to 2% a year. Well, probably not so important. In a 5-year span, not a big deal, right? Okay. Still consider it. All right, we beat that to death. There it is. See, I just didn't find it. It was there. How could I doubt that? Okay, so this is different. Why did they put this in a separate chapter or portion of the chapter? This other reporting issues. Accounting changes in errors and changes in accounting principles. Why is this thrown to the back of the chapter instead of being up in the middle of the income statement chapter?
Because you do it for the period after.
Yeah, it's a prior period for the accounting errors, right? Prior period adjustment, we're going to call that. And changes in estimates are prior period too, aren't they? You don't treat them that way, but they were done in the prior period. And accounting principle, we've been using one principle, we're switching to another. Where does all this stuff hit? Not on the income statement. Where does it go, gang? Retained earnings statement. Okay, got to know that. Retained earnings statement. Okay, so what are we going to do, right? Retrospective adjustment, what does that mean? We're going to go back and restate the prior years, okay? Cumulative effect adjustment into beginning retained earnings. So it's a what if. What if I had been using this other method, right? Okay. Adjust retained earnings. Or I'm going to correct the error. By the way, if there's an error, where does the error end up? My revenues are either over or understated, or my expenses are over or understated, right? There's an error in my revenues or expenses. Where does it end up, I suppose, guys? In retained earnings. How do you know that? What do you close all your revenues and expenses and gains and losses to every year? Retained earnings. So where's the error when you start a new year? It's in retained earnings. So guess what we adjust for these? Retained earnings. Got it? Or if you're going to change accounting principle, where is the effect of the change of accounting principle for the prior year is going to have to go? Retained earnings. Where should the effect on the current year go? On the income statement, huh? Everybody got it? Of course, we'll use the new accounting method on the income statement, and there's no correction of an error on an income statement. Why? We're just issuing the income statement. We do it right. Why would you do it wrong and then do an error correction? And nobody's going to do that. So corrections of errors are always prior years, right? Make a current year correct. But changes in accounting principle will do what? Or a change in an estimate will do what? Well, that affects the prior years and the current year. Okay? But you just use the new stuff in your current year in your mind. Okay? Your revenues and expenses will be correct. But you would disclose that you have those changes. Okay? So examples for a change in accounting principle here, what do you think? Cumulative effect of beginning retained earnings approach preserves comparability across years. So if we're showing 3 years income statements, right, which we'll do, and for a publicly held company, we'll restate all 3 years. And the beginning balance of retained earnings at the earliest year gets restated, okay? As though we had been using that method in the earlier years. That's all. Okay? Preserves comparability across years. Change from FIFO to LIFO, or average or something. Go the other direction too. Inventory. Change from percent of completion to completed contract. Okay, now what's the deal? We were using a generally accepted accounting principle before, and we still are. Everybody got the idea of that? We were using generally accepted accounting principle before, and we're still using generally accepted accounting principle. What if I was violating GAAP before, and now I switched to GAAP? So I violated it, and now I'm in conformity with GAAP. What's that? That's a correction of an error. Would I ever go from following GAAP to not following GAAP? No, we're not going to do that. Why does anybody do that? Okay, so you don't do that. Okay, so if your mistake was not following GAAP, that's still a correction of an error. Got it? Okay, so it's GAAP to GAAP on this. That's fine. These aren't that big a deal. Okay, and they run through an example, and we'll do some of these when we do a review. Maybe we'll do these. Actually, try and do a few of these calculations. Change in accounting estimate. What's that? How does that one get handled? It's accounted for in the period of change or the period of and future periods if the change affects both. What about prior years where that estimate would have affected it? No change. We made the best estimate we could with the information we had at the time. And so any change in it affects this year and future years. So I made my allowance for doubtful accounts way too big. With hindsight, I realized that. What happens? You have less bad debt expense now. The allowance is already big. Did you overstate bad debt expense in prior years? With hindsight, I guess so. But you made the best estimate you could. You got the idea? So you have to decide if you have a change in estimate or a correction of an error. What if I made a computation error and that caused me to have too much allowance and too much bad debt expense in the earlier year?
Then you go back.
Now I got a correction of an error. What if I made the best estimate I could, given the information I had? Now I have a change in estimate. Got the idea? And don't play games with this, right? Don't convince yourself, oh, I'd really rather have it be a prior period adjustment to hit retained earnings instead of hit current year income, or whatever it was. Right? Maybe it makes me look better. Well, then maybe what I'll do is call it a prior period adjustment. Or I don't want people to think I made a mistake. So I won't call it a prior period adjustment. I'll call it a change in estimate. Don't go there. Okay? So anyway, they're not handled retrospectively. They're not considered errors, right? This isn't an error in this case, right? It's just you changed something, a useful life or salvage values. Your estimate turned out not to be great after all, with hindsight. Allowance for uncollectibles, inventory obsolescence, those sorts of things. Okay, so the journal entry going to be for those sorts of things? What would the journal entry have been if it's a correction of an error? Or a change in accounting principle? What's it going to be? It's going to go to retained earnings, isn't it? Right? This debit here, instead of debiting depreciation expense, would be debiting retained earnings. Because you would have already closed depreciation expense in the prior years, right, to retained earnings? So any error goes there. What if it's going to be a change in estimate? Hits the current year and forward into the future. Got it? Remember when we did that? We changed the useful life of assets and we changed the depreciation. Remember the principles? We didn't go, when we were doing depreciation, the property, plant, and equipment depreciation chapter, we didn't go back and change the prior years, did we? We left those alone, and we just modified what the depreciation would be going forward. You know, if you extended the life or shortened the life, or you switch methods, right? New information comes to life. That was a change in estimate. We just didn't call it that. So that would be the journal entry. So not a big deal, huh? What about a correction of an error, though? This is where you really made a mistake. A math error, mistake in applying accounting principles, we violated GAAP. Oversight or misuse of facts, I should have known the information, but I didn't know it, that kind of thing. They're treated as prior period adjustments, that's what we call them. Correction of error is a prior period adjustment. And we adjust the beginning balance of retained earnings, okay? Same with the cumulative effect of a change in accounting principle from prior years. It's going to go to the beginning balance, okay? So there's the journal entry. See the difference? Change in estimate is going to hit the current year income statement. It's going to be a revenue or expense account, right? Correction of an error is going to go to retained earnings. Okay? That's it. Okay. And we've got another sheet that does all of that for us on page 181. Okay? Change in accounting principle, change from one generally accepted principle to another, right? They give you an example, 5 foot of life or something. Recast prior year's income statement on the same basis as the newly adopted principle, right? Okay? And then account for it that way this year too, okay? And then we're going to go back and restate the retained earnings for that one too, right? Okay? Normal recurring corrections and adjustments for changes in estimates. So they give some examples, and then show change in the affected accounts in the current and future periods, not shown net of tax, of course. By the way, why would this one have to be shown net of tax? Whoops. Why would this one up here have to be shown net of tax? The adjustment goes to what? Retained earnings. Well, retained earnings doesn't have an income tax expense line in it, so it has to be shown net of tax. What if it makes your income more in prior years? Be a tax expense. You'd reduce retained earnings by the tax expense. We'll do some examples of this stuff. Okay. What about if it made your income more in prior years? I said that. More tax expense. What if it made your earnings less in prior years? Tax benefit, right? You have to factor into it. Okay. And then the changes in estimates, what's happening? Not shown net of tax. Why? It's up in operations, right? Yeah. Okay. It's in the current year operations, so it'll affect the tax expense line. That's all. Okay? Corrections of errors, prior period adjustments, they have to be shown net of tax because they're going to retain earnings, just like the change in accounting principle. Okay? And we will start, I guess, there. Now let's do this real quick. This is so simple. What goes on a retained earnings statement? Things that increase it. We did this key accounting principles, remember this? Beginning plus any income, less any loss, less dividends. What are we adding here, you guys? Changes in accounting principle, right? And prior period adjustments. That's it. That's all that can hit retained earnings. So we've got positive and negative prior period adjustments and positive and negative changes in accounting principles. They both go in there. Okay? So where do you put them? See it? Right at the beginning. Balance at the end of last year, beginning of this year, prior period adjustment, and you have a restated balance. Got it? And then there's the net income, there's the dividends that you get ending retained earnings. Maybe here someday. Let's try it. Okay, no, good. But anyway, that's what you do. Okay? What's an appropriated retained earnings? I have regular retained earnings in an account. Am I setting money aside to do an appropriation? Not necessarily. Probably not. let's say that I have a lot of retained earnings in my shareholders really like a dividend, and I want to communicate to them that they can't have a dividend, even though I have a lot of retained earnings. I'll appropriate for plant expansion, maybe. I'll appropriate for retirement of a bond issue, whatever I'm going to do. All you do is you debit retained earnings and you credit retained earnings. You debit unappropriated retained earnings and you credit appropriated retained earnings. Smoke and mirrors, huh? So what does appropriated retained earnings tell people? Oh, we don't have retained earnings to pay dividends with because it is tied up for some purpose. Okay, so let's say it was for a plant expansion. We set up appropriated retained earnings for plant expansion. After you do the plant expansion, right? You didn't set any money aside for the plant expansion necessarily, right? After you do it, what do you do to the appropriation? Get rid of it. How would you get rid of the appropriation? Credit regular retained earnings and debit appropriated retained earnings. I'm not kidding. You'll actually get points for knowing that kind of stuff. So we're picking up right there next time. Remind me where we were. Comprehensive income we want to talk about. And then we'll go on to the next chapter. And after chapter 5, we will really do number crunching, I promise. And there's some number crunching in this chapter too. We're going to work through problems, right? But they're all the stuff we've been talking about. See you guys. Keep working, keep working, keep working. I apologize for taking so long to get your test back. You can blame God for the snow. That's what happened. Wrench in the works. What's that?
Such a headache.
Oh, fine. First fun.
And theology. No, I'm supposed to be there.
No more class.
And if they give you a 5, you can have more.
Tanner.
Huh?
You don't
Tanner.
try to say
You're talking about not having a class,
just one.
right? About it.
And see you wrong.
I borrowed some
She had so big.
somebody.
The whole summer she got out.
Is that God over here?
Really helpful, aren't they?
I know.
I told you.
That's because
Oh,
Ryan.
sorry.
Well, if I convinced you,
Sorry, I overstated that freaking ass.
I'm right.
you can get 4
Yeah,
books
you wanna ride?
and 5,000 citations online or on the disc for
I don't fly you for flying.
It's alright.
So all these questions are including you see how that is
Kind of needed that. You didn't want to close it. It's fine.
I am not trying to forever.
yeah, it's all right, real fast. Yeah, you know what you're doing. You get beat up really easily.
Well, after I found out chapter 3 was chapter 3 for the Alpha, I really needed to go. So I forgot where it all began.
Yeah.
I borrowed the first couple of bucks.
Pay the price, and I don't mean pay the price for this class, pay the price for the career.
Yeah.
Okay? And know what you're doing now. I can tell you a story of what I know right now. Don't do that. Don't do that. We can get through here and we can do this course and the next course, instead of half-assed it.
Yeah.
Leave there and not be very lucky. That's a really good investment. Just think about it this way. You don't have to buy it. What you're buying. Right? And those 4 books will do the whole curriculum. The whole curriculum. First, go to their site. And if they say they don't know who Bellarmine is, which if he hasn't renewed the site yet, that happens all the time. He has to do it every year. If he hasn't renewed it yet, then they won't give you the deal. So don't buy unless they know it's Bellarmine and give you the deal. And if he hasn't done it, email Dave and say, would you renew the site license? Because, I'm not getting a deal to buy. He'll know what they're doing. Okay.
Those books are so helpful.
Only the chair can do. What's that?
Those books are so helpful.
Oh, they're so cool. Yeah, they're really good.
Alright.
You'll have one in your hand to study with. It's
Yeah.
really nice. Well, you had borrowed friends.
Yeah.
Yeah.
Alright.
They're really good. Gleim CPA review books. Yeah, you have your set? Do it. It's worth the money. Again, you're not going to buy a book for $2 212, right? Sold.
Well, there.
That's your book.
Okay.
Buy it now. No, call your grandma. Christmas present early. Birthday present early. I'm serious.
I
Get
wish
those
I
books.
could.
Get those books. And if you buy all 4 of them, like I was just telling her, you get unlimited questions, either online or on the CD-ROM. They're probably good online nowadays. Up like 5,000, right? You can just work your heart's content. By the time you work through a bunch of those questions, you'll do well in all your classes. And by the way, these 4 books are going to do tax, they're going to do cost, they're going to do audit, they're going to do business law. Got the idea?
Yeah.
You know, yeah, of course you have to search through to find questions that are applicable. But my auditing students, a bunch of them have access and they're using them, and a bunch don't have. And the grades will just be, you can just tell who's who. You know, there's only about, in the auditing book, there's about 20 at the end of each chapter. Is that about how many are out there?
Yeah, roughly.
Yeah, yeah. So you want to do 20 or you want to do 200 on a chapter? Or maybe 300 on a chapter?
Closer to 40.
Yeah. 40 you're doing?
400.
400. Is it about that? About that? And you know, they're the same question after a while. You're like, oh, yeah, I already know that one. And a little twist to the question, a little twist to the question.
Yeah.
What are they going to ask? It's only so much. You're going to remember what one I'm on, Matt, right, guys? 40,
Yeah.
63. 63. We're almost done with this chapter. These are useful, these PowerPoints, for 1, 2, 4, and 5, but other than that.
You know, Ashley Pascarella, she's in one of your classes. She did pretty good on the first quiz.
Yeah, name is familiar.
Because she came to one of the tutoring sessions, and I asked her what her major was. And she said biology. She's taking her class for fun, and she's doing really well.
Okay, well, we need to talk to her when I'm sure you will.
Yep. Problem is, she's about to graduate.
That's all right.
Yeah.
She could do the accounting certificate.
That's what I realized
Yeah,
after she left.
yeah.
I was like, okay, I'm going to talk her into this.
She came to get tutored.
Yeah.
Well, what's she going to do career-wise when she graduates? Well, maybe if she go to pre-med or something, all right.
Yeah.
You know, she's going to go to medical school. But if she likes this stuff and she's interested in it, have her come and talk to me. Tell her not to be at home.
Because she's taking her class for fun.
Yeah,
Doing well,
and
she's
she thinks
enjoying
it's fun
it.
even. There's something wrong with her. That is you. Give her that. And show her the different versions in there.
Right.
You've seen this thing, right?
Yeah.
Maybe. We have scheduled your life forever, haven't we?
Yeah.
We did do that.
Yeah.
And we scheduled yours, I think.
I'm glad we did, because I got my new advisor